Well, welcome everybody to the February edition of the Roundtable. This is something we do for all of you. The whole idea is to come together, share some ideas, share some stock ideas, and demonstrate some study techniques and that sort of thing. Tonight's program is a little bit different in that we hand out statues of Golden Knights in recognition for some good selections made in the past and some all-time statistics, and you'll see as we go into that that every once in a while a blind squirrel does find an acorn or two along the way. I'm joined here tonight by a whole bunch of people. Not everybody could make it, but again, just going through the roll call. Kim Butcher, a very accomplished investor from Evansville, Indiana, who's joined us for a number of programs as one of our guest damsels. My good friend and colleague Ken Kabula from the Mid-Michigan area. Does all kinds of investment education stuff. Herb Lemkool from Traverse City. I'm not sure Herb's going to be able to join us tonight, but Herb is a member of one of the winning investment clubs in our stock picking contest a few years ago. Cy Lynch from Atlanta, Georgia, same thing. He basically teaches investors nationwide and has been doing this for now a few decades. Susan Michalik from Wisconsin, probably not able to join us tonight, but again, she's participated in a number of programs as a guest damsel, and she's a member of a winning investment club and just all around good stuff. Ann Manning, one of our groundhog champions from years ago, often joins us here. Hugh McManus, winner of our annual groundhog stock picking contest this very year, joining us from Pasadena. And again, he's been doing this stuff for a long time and has quite a track record. Matt Spielman, one of our kind of newcomers. Love Matt's participation. He's from the Mid-Michigan area also, not too far from Detroit. And Matt's had some pretty interesting sessions here over the last couple of years as a guest night. And Nick Strategos from Pittsburgh, who will be joining us. That's Nick with the Stanley Cup in the Pittsburgh County, New Jersey there. Again, these people have all served select stocks and next out, and all part of having some fun doing this stuff for you guys. Here's the housekeeping for tonight. No investment recommendation whatsoever is intended. It's all about education. It's all about demonstrating and illustrating the philosophies and methods of the modern investment club movement. Here's our standing agenda. Again, for those of you that have been with us in the past, welcome back. Those of you that are here, extra big, special, warm, late February hug to all of you. This is basically the lineup for the evening. We do have a couple of extra special moments tonight where we take a look back at some things that we've done in the past, but we will be presenting Air Lease, ticker symbol AL, tonight. PRA Group, the old portfolio recovery, Ken's going to share with us. And I'm going to go into Chicago, Bridge and Iron. And Hugh McManus, being the stubborn Irishman that he is refusing to pick a stock because he can't find one that he likes. And that's a theme that you've heard him talk about in the past, and he's going to go more into that. As Ken was saying, there will be an audience poll on the stocks that are suggested and reviewed here tonight at the end. So let's go ahead and get underway. We do like to remind what we're doing here. We've been here doing this about a monthly webcast now for almost 5 years. The intent is, just like in that highlighted area says, the intent is for all of us to bring our single most favorite idea at the time of the session and place it in front of everybody. Many times there will be repeat selections. We apologize for that, but sometimes the best ideas are going to come from selections that have been made in the past. There's no way to avoid that because we really are trying to deliver a steady stream of actionable ideas. And when we say actionable, we mean worthy of really putting them to the test, testing their mettle with a stock study, usually done with friends. And our long-term goal is to beat the stock market by 5 percentage points. So again, we try to beat the Wilshire 5000 by 5 percentage points over time, and we'll look at how we're doing in that regard here in a second. And we'd also like to see the stocks that we choose outperform the market. We'd like to see that happen 60 to 70% of the time, and we'll show how we're doing there also. Well, here's a look at our longer-term scoreboard. Again, what you're looking at here is now nearly 5 years of quarterly and then monthly results where we're looking at our relative return. And defining relative return, it's basically taking the actual internal rate of return achieved by the selections that we make and subtract or compare that versus the Wilshire 5000. Again, if we match the market, if we matched the Wilshire 5000, we would come in at 0. And in this case, you can see we're almost, it's 1.8, but almost 2 percentage points better than the market since inception. And I think without squinting, you can basically say going from left to right, that overall trend has been pretty healthy. Now we do have a little over half the selections have outperformed the market. There's a whole bunch of them very close to the bubble, and but over the longer term, I wouldn't be surprised to see that number creep up towards 60. Pretty good year in 2014. Basically beat the market by nearly 3%, and that's how we ended up a little bit higher at the end of the year. And for the year, we did select nearly 60% of the selections we made beat the market. Any questions or comments at this point, Ken?
No, I think things are going pretty well right now, Mark.
Okay, we'll just keep pressing on. Here's the most common selections, or basically the highest value or most influential positions that have been made over the years. As we said, every once in a while we're going to have a repeat selection. The numbers that you see in parentheses there are the number of times the stock has been selected. You know, I think Cognizant Technology, I think Sty probably has a picture of the Cognizant Technology staff in his, above his fireplace.
Well, and you could have, I mean, those of us who work on teaching could have, like they do to invest that, have a timer thing in, 5 minutes left.
Yeah. We're not a bad idea to do that. We get ourselves off schedule, and that'll really mess people up if we want to answer back.
Yeah.
I think we got, Ken, are you there?
Yeah, I'm here, Mark.
Could you hear that discussion going on in the background, or is that just me?
I could hear the discussion, but I have no idea where it's coming from, Mark.
Okay. Somebody's unmuted that doesn't have an unmuted, probably.
I heard it too, but I don't. Kim.
Okay, no problem. Okay, so what you're looking at here from top to bottom is the selections that have how they've performed. In the case of Cognizant Technology, it's been selected 11 times. And what we do every time a stock is selected, either by a contributing knight or damsel or the audience, we invest $1,000 in it. So $1,000 has been invested into Cognizant 11 times. So $11,000 has now become $18,000 as we look left to right here. So it is the most influential stock in the portfolio with respect to our overall performance. And I know many of you sitting out there in the audience have Cognizant either in individual portfolios or in club portfolios. So just kind of reading across, you can see the statistics for, again, the most important characteristics we think of as we think about these companies. Apple in the number 2 slot has been selected 6 times. I believe I've selected it at least 4 times myself. I'm happy that I've done that because that $6,000 has become $12,200. Again, this is just our way of keeping track of the results of the actionable ideas that we try to bring before you. Any stocks on there that you would like to highlight, Ken, or anybody else?
Well, I always like to look at the ones with smaller numbers of choices that make this top list, and so I go down near the bottom with the stocks that were chosen only 2 or 3 times, and I just wish that we would have had the foresight to choose them a number of times more than we did. I'm looking at PRAA, for example, chosen twice and more than doubled in the 5 years that we've been running the exercise. ResMed chosen twice, another more than double in the 5 years that we've been running the exercise. So I think that we're looking at some great choices in stocks, and if we were to examine the entire list, and maybe we'll post that somewhere one of these days and make it available so that you can see how the entire list has fared along with these numbers that Mark has added with numbers of choices. I think that's always extremely interesting to see the kind of appreciation that goes on in stocks that aren't really sexy and they aren't really very well known, but they certainly have brought in a nice return over the last 5 years.
Yeah, and keep in mind, I've actually posted the public link up here at the top. You can go and see the entire list. There's about 95 companies, I believe 95 positions listed. But if you go to this link, again, you don't need to be a Manifest Investing subscriber to do it, but you can go to this link, and the roundtable tracking portfolio is there. And some interesting stories there. All right, we're going to go ahead and press on tonight. We're not going to spend so much time talking about the portfolio. I would like to get into the awards for obvious reasons. Here as we get started with the first award tonight before we start talking about our stocks is for best selection made during calendar 2014 or basically the last 12 or 13 months. And this is a prestigious award, won first back in 2010 by me. But Ken has had a 3-year run. Notice Mr. Cavula's actually had 3 straight years of the best selection for any given year. And this year, Apple came through for me, came through for us. And it was quite a good year. I mean, this is a little bit better year than I've been accustomed to. Is that fair to say here in the last few years? And my name does appear quite a few times on here, guys. So
you've hit the nail on the
this
head
is kind of my opportunity. What was that?
You've hit the nail on the head. That's it. Yeah. Very, very fair to say.
that my name hasn't appeared often enough in there?
Who's the real young girl that you picked up for this picture in the corner, Mark?
Well, you know, as I'm here accepting this award on behalf of my family and, you know, my mother and the family dog and all that and everything else, this happens to be my wife. And a really fun night that we had when we were out there on the red carpet ourselves. And she has a lot to do with this stuff, too. She has Apple in her portfolio. So that's pretty good. But again, you can see the audience actually came along for the ride on at least 3 of these. Interestingly enough, I think it's kind of interesting that the Universal Display and Maximus were picked both by Ken and myself and the audience. And I guess we don't need to say any more. I mean, although I will point out one thing before we move on tonight. I'd like you to go back in the time machine, you know, in that hot tub time machine thing that they've been talking about. You go back to last year's poll after last year's roundtable session. And, you know, I hesitate to rub my nose or rub your noses in all of this, but here were the 5 stocks presented a year ago in extremely powerful presentations by all of these. All of these stocks have done fairly well. One of them did much better than everybody else, but they've all done well. But I would also like to point out, you know, when you go to the polling session, you have your opportunity to, you know, to join with me. And here, we'll just leave it at this. I mean, that doesn't even get you through the primaries in an election process. And you had your opportunity to jump on the Apple bandwagon, and you know, you just might want to rethink that sometime. Anyhow, these were. If you look back at the session a year ago, it really was quite a good session. Nick's presentation on Stericycle was very good, as was Susan Michelik's on Caesarstone. Both of those have actually done very well. And of course, Silence had to be cognizant. All right, so I think we'll just go ahead and press on because you guys want to talk about this. And let's go ahead and open the door to, I guess, the skies to Mr. Spielman. Matt did a fantastic presentation on Air Lease. You'll hear more about here in a few minutes. Back in April of last year, and he's basically bringing us an update on the subject. Take it away, Mr. Spielman.
Yeah, thanks, Mark. And as you said at the top of the hour, sometimes your best idea comes back around, and that shouldn't be a bad thing. As you see, I did see Apple following Apple in the top list there, and several other picks. It so happens Air Lease is still on my radar and one of my favorite stocks to follow and to invest in. It has been positive for me. I think just recently I got my head above water and I'm a percent above the Wilshire, but it spent much of the year underwater as the drama in oil and therefore its airline customers have impacted the price back and forth. But it's still a good bargain today. As Mark said, I did an extensive presentation on Air Lease last April, so if you're new to the company, I encourage you to go back and look at that. This is going to be an update for the year. It's been almost a year through. In fact, Air Lease will report its fourth quarter earnings and full year earnings on Thursday, so this is a preview of their earnings cycle. Maybe you have a couple days to read up on it ahead of that. So let's go ahead, Mark. Next slide. So Air Lease will just turn 5 years old today, or not today, but this year. But it's led by an industry veteran, Steve Haase. In fact, Steve Haase founded what was the biggest aircraft leasing company in the world, ILFC, International Lease Finance, which has recently been sold by AIG, who bought it from Steve, into AerCap. So that would be a good comparison company to look at. But when you think of a new company, Air Lease really doesn't fit that. And one of the things is illustrated in this slide. So not once but twice this year, Air Lease, and really Steve by force of his personality, has impacted the product offerings of Airbus. In the top, we have the A330neo, that's new engine option, which is an incremental change to their existing medium wide-body aircraft. Air Lease was pushing their A350, which is a carbon composite airplane, much like Boeing 787, and they were trying to sell a short fuselage version of that, which impacts negatively their fuel economy. Steve managed to convince Airbus that a much better operating economics would come from an incremental change rather than pushing the brand new thing. And Airbus did, in some ways, just say capitulate. I think they were a little reluctant to do so, but you see, where you usually see renderings of an airplane with the launch airlines colors, because Air Lease was pushing it, you have what you'll never see in real life, the leasing company's logo and lettering on an aircraft body. Likewise, in the bottom picture, we have the A321LR, or long-range Neojets. The A321 is the biggest single-aisle airplane, so the biggest small airplane Airbus makes. And the niche here is to find an aircraft that will replace the 757. Boeing stopped making the 757 in 2004, and it's a place above where you'd find the A320 family or 737, but below what is the 787 or A330 or the older 767. And it's quite popular on transatlantic flights and on vacation flights like to the Caribbean, and no one really has something to match it. So again, Steve really pushed Airbus to find a home to replace this more than 10-year-old aircraft, or the youngest one's more than 10 years old, and has been pushing Boeing as well, although Boeing has resisted so far. So here you see what's a new company, but with very experienced and connected leadership. They are moving the market. Next slide. So here's a few charts. The first chart, the one on the upper left, is just comparing their aircraft order backlog. These are orders by Air Lease to the major manufacturers. The top line is April 2014, so as I gave my last presentation. And the bottom line is as of the third quarter report, which came out November 6, 2014. So in 6 months, you can see they've actually added 50 planes to their order book, and not all of them are in the after category, that is orders for years delivery after 2018. They've been incrementally increasing the orders each year going out as they find open slots from the airplane manufacturers. In addition, those are actually committed orders. If you see underneath, there are another 70 aircraft that they have options for, that they can order, but they haven't committed to the orders and to penalties if they tried to back out. So you see 70 more aircraft. All of those are orders that came in this year. And you see a mix there, and it's very important to see a mix of the A330 and the A350. The Dash 1000 is a larger body, and then again the A321, so a smaller airplane. So that mix of large and small but a very limited model mix. These are the popular ones that if one of their lessors ever did fail to pay and Air Lease had to take the plane back, it's very easy to find someone else who wants these aircraft. Looking to the chart on the right, one of the important things too is so they have committed orders quite far out. Now are they able to lease those aircraft? And so the company guides that they try to sign leases for these aircraft 18 to 24 months in advance. And again, this is as of November. So 18 to 24 months in advance. Of course, you'd want 2014 to be done, but so 2015 should be 100% leased, and 2016 should be 50% leased. So you can see from this chart with the demand for these aircraft, and think about if you're an airline that's just thinking that you want to increase capacity or perhaps you want the efficiency, and these new generation airplanes have 20% fuel burn efficiency, you're going to have to wait 2018 or longer to get one of these. A way to get the efficiencies much quicker is to lease something in one of these slots that are available. So their lease order book is far ahead of their target, and has prompted them to continue ordering more airplanes because of the strong demand they see. Looking at the chart on the lower left, one more chart, just to show you where the fleet is today. So this order backlog of 372 is as of September 30th on a basis of 200 airplanes. So you can see, if you think of that as revenue growth, as they bring assets in and they're leased, that's revenue growth. There are many multiples of their revenue to go over this time frame. But what also is important, and it's a little bit of a long phrase, weighted average remaining lease term. So that just means lease term as it measures the value of the airplane. So some are big planes, some are small, how they go together. There's still a remaining 7 years on all the assets they have today. So if you compare the bottom chart and the top chart, if we add all those planes to 2018, they're still leasing the planes they have today, and all those leases are going to be additive to their revenue book. So these are generally the leases they do. If you add those two columns, the age and the remaining lease, they generally lease about 10 years. They can vary from 8 to 12 years. Those are the prime years of a plane. An airplane's stated life or design life is 25 years, although many planes work for much longer than that. But Air Lease tends to lease out the first 10 years of an airplane's life, and then disposes of the plane while it still has substantial book value to other people to worry about older assets. That's an important thing for two reasons. One, it keeps their market fluid. So these are airplanes. Not everyone in the world wants to buy a big airplane, but everyone wants these planes because they're fairly modern. But two, when you do a transaction and it's 10 years straight, that makes for a very smooth revenue curve. This isn't a consumer company. It isn't a bumpy revenue curve. It's very smooth with the decade commitment by customers. Okay, last page. There's 2 points if you're going to catch up with Air Lease that you definitely need to know, and that's when you look at their debt. Air Lease as a finance company is high debt. Think of it very much like a bank or other finance company. It's not a manufacturing company, but there's a very unique mechanism they've put in place that they call Blackbird Capital One. And you definitely want to check up on Blackbird to see what it is. So that's going to bring another $2 billion of liquidity to Air Lease, but it's not just more of the same business. It's actually looking for them to be a minority partner, but the managing entity of, but allowing other people, other hedge funds, institutional investors to participate in their business, and it's very complementary to what Air Lease does as its core business. It's not going to compete with itself, but that is actually going to execute by the end of 2016. So think of $2 billion in more transactions coming in the next 2 years. That's quite a quick pace. In addition, the last comment lower right, just a couple of things to look here. One key thing for Air Lease is that when it offers debt, it's unsecured debt. So by being unsecured debt, it's not tied to any particular airplane that they're buying. So that allows them this flexibility to sell planes at the end of their first lease, or even if there's a few years of lease left. They can opportunistically buy and sell assets just like they're opportunistically finding debt, which is not a flexibility that airlines generally have, and even a number of other lessors don't have. The other thing, of course, is 3.75%. So they are loading up on a lot of debt right now at very low, as everyone who's borrowing now knows, low fixed rates. So they are insulating themselves from any kind of, I'll say, rate normalization, but really rate increase by locking in low rates now and trying to extend the due date. So their due dates right now generally range into the 2018 area, and if you notice, that's where they are projecting individual commitments to. They are very active to extend their due date and keep these low fixed rates available for them to keep their margins wide. So I definitely am still happy with Air Lease, although it has outperformed the market slightly. It's still a very good buy and an interesting company. It's 17 trailing PE, which puts its price earnings to growth or PEG ratio under 1. So such a steady grower, more than 20% revenue grower for a projected 5-year horizon. With stability you won't find anywhere else. It's a very interesting company. That's Air Lease.
Thanks, Matt. Yeah, it's really performed very well, and obviously they command considerable respect from the lending community. When you look at that 3.75 unsecured, that's pretty powerful. And again, we encourage investors to take a look at, what are lenders, what rates are lenders willing to loan at for companies as a measure of their financial strength. That's basically telling you that on the street, this is a very, very highly regarded from the perspective of financial strength. So just one takeaway for you. Thanks, Matt. Let's move on and squeeze in one more statue. This is for the best selection all time, so it's not just the 2014 performance. And it goes all the way back to inception, so you'll see companies that were selected back in the 2010 timeframe. These are the ones that have had the best performance over the years, and you see quite a distribution of contributors on this list. TGX was a great company for Ken back in the early days. Portfolio Recovery, which he's going to be actually revisiting here tonight. Southwest Airlines, Hugh was the leader last year on the wings of Southwest Air, and that performed quite well and has gone on to perform even better in days following that. But again, just looking down the list, a large number of people, the Walgreen selections by Hugh make this list. A couple of Cognizants. Anything, reach out and grab anybody on the list there. I see Polaris is one that kind of fits that tab of it's only been selected, I believe, once, Ken, and has performed extremely well since April 2013. And this year's award does go to me. I get a few more statues this year than I'm accustomed to. Inteliquent was kind of one of them that you guys all held your noses over, and this is the old neutral tandem that seemed to be spinning out of control and perhaps out of business, and they have recovered quite nicely, so maybe that's a bit of an accident, but they did quite well during the period that we hung on to them.
It's a sweep so far.
It's a sweep so far. The sweep ends when we talk about the longer term stuff usually.
You're not going to come out in your underwear, though, are you, Mark?
Only if we get an intense demand, and I can't imagine that.
Okay, okay.
All right, let's keep pressing on. As we said, Ken is going to go ahead and go with the old Portfolio Recovery, and that graphic on the screen definitely screams pretty consistent. Just kind of kicking things out.
I'm going to move to my screen here real quickly and bring up some slides. And I'm going to start with a couple of slides right off the PRA Group website. This is off of a recent investor presentation that PRA Group made. It's dated in November, so it's relatively current. And it starts with just explaining what PRA does in the United States. And by extension, a lot of what they're talking about in the U.S. also applies to Canada. There's about $2 trillion of consumer debt in PRA's addressable North American market. And the regulatory environment for collecting this debt is changing rapidly. First of all, it's affecting the supply of debt because banks have to be much more careful in who they sell their debt to. So the amount of debt out there to buy by these private companies is being affected straightforwardly. The OCC, which is a federal regulatory agency that holds banks accountable for the rules and regulations that they have to follow, is telling banks that are selling debt that they must have higher standards. What that means is that they must be selling to companies that are willing to adhere to all the new rules that are out there for debt collectors. And all of these things are pointing towards significant barriers to entry for any competitors. PRA is finding it more and more of a large moat or a wide moat company because of all the barriers to entry for any other debt collector to have to move into this space and compete. There's also some longstanding PRA policies that are beginning to match a lot of the regulations that are being put in place for debt collectors. And PRA is finding it easier and easier to acquire portfolios of debt at very attractive margins. Now we look at the European debt buying market, and there's also a huge opportunity for growth. If there's $2 trillion in the North American debt market, there's almost that much, $1.6 trillion, in European non-performing consumer loans. The market is much less mature than the U.S. markets. Holding a lot of debt is relatively new to the European consumer as opposed to the American consumer. Financial restructuring is driving increased sale of debt. You only have to look at countries like Spain and Portugal and Greece to understand what that means. And there's been increased regulatory capital requirements for banks in the European Union, and that puts pressure on banks to improve their return on equity and to cut their costs. There's also a use of resale as funds look to exit and monetize distressed investments. So we have hedge funds and we have other groups of people that have put money together or put together portfolios of investments looking to resell some of the non-performing loans, resell some of the debt, and this plays into PRA Group's hands. Now, PRA Group has been very clear in its strategy going forward. PRA Group has acquired 2 companies in the last year. One of them is Active Capital. That's a Norwegian company. And Active Capital was almost the same size as PRA Group when it was acquired. The other company is a smaller company based in Canada that includes debt processing in Europe and in Canada as well. You can see the amount of collectible debt that Active Capital has added to the PRA purchases of debt in the 2014 fiscal year. Again, this is only covering the first 2 quarters, and we'll have a 4th quarter report from PRA Group on March 2nd. Now here's the thesis that management's been espousing for over a year now. I've owned this company for a long, long time, and I do listen to their earnings calls, and I listen very carefully to what management tells me they're going to do. They telegraphed these very large expansions, these very large acquisitions of the 2 companies. They telegraphed that well in advance and made it clear that they wanted to move into the North American market and the European market in a much larger way than they had ever previously had a presence. And they indicated that their new acquisitions would take a little bit of time for them to digest. They'd have to move to a single culture, and most importantly, they would have to change the collecting algorithms that are used, and the old companies were using algorithms that were not producing nearly the kind of profit that the PRA Group algorithms were producing. So they had to bring the margins of profit from the acquired companies up to match the margins that PRA was used to. They told us that the first 2 quarters of 2014 were going to have rough comparisons. And when we look at the earnings per share, this is right off the value line sheet, when we look at the earnings per share for the first 2 quarters, we do see that the growth slowed in the first quarter, and then they actually made less money in 2014 than they had in 2013 in the second quarter. But management also told us that by the second half of the year, these 2 companies would become accretive to their bottom line. In other words, they would start adding earnings to the bottom line. Well, I look at the third quarter and I see that earnings are back on track. That's a pretty nice 10, 12, 13% increase in earnings during the third quarter. Not as dramatic as some of the earnings increases previously, but then I see that the projection is to perhaps have as much as a 18, 20, 22% increase in the fourth quarter. They're going to announce this fourth quarter in a week, this coming Monday, March 2nd. And if, in fact, everything is in place, then I think the people that don't follow the company as closely will suddenly rediscover that this company is extremely profitable and that it has managers that seem to know what they're doing. I'm looking very carefully at what happens this coming Monday. I'm hoping for the $1.12, but I'm not going to be disappointed if I see something in the range of a $1.09, $1.10, and anything above $1.12 I'm going to be very pleased with. That'll tell me, I think, that the thesis that management put forward more than a year ago is on track, and that this new business in Europe and in Canada especially is going to prove to keep the company growing at a very exuberant value. I'm looking at the growth numbers. I saw that during the recession, PRAA sales slowed, and that was because they were out there as fast as they could, buying up debt left and right at values averaging about a nickel or 6 cents on the dollar. Notice how fast they came out of the recession, how quickly the graph grows, and that's telling me that they were able to capitalize on that very cheap debt that they bought and turn it into a tidy profit. I think the same thing is beginning to happen now with these new companies, and as margins increase, I think you'll find that trend line moving up. I've estimated the growth trend to be somewhere in the 12-13% range. I'm looking at the normal measurements for a growth company. I'm looking at pre-tax profit on sales moving in the right direction, return on equity moving in the right direction, and debt to equity moving in the upward direction, but I know why. It's based on these 2 large, in fact, huge acquisitions that the company made in the last year and a half. The total return I'm coming up with right now is about 11%, and I'm coming up with almost exactly a 3-to-1 upside downside. I beg you to notice that Mark is analyzing the company in a slightly different way. I don't especially think that this company needs to be analyzed, even though it has its basis in finance. I don't think it needs to be analyzed by book value like you would do a bank or an insurance company. And again, I've chosen to analyze it as a traditional growth company using earnings per share and return on equity and net margins. Mark's analyzing this using book value, using some values that are very close to values that I've chosen, and he comes up with a projected average return closer to 16%. It's certainly within my range of 11 to 17%, and I think either analysis leads me to a company that has the potential to really move forward. Again, I'm going to put a lot of emphasis on what happens this coming Monday when they report their earnings, and I've learned in the last 3 years in this very volatile market that a really good earnings call moves the stock ahead quite a bit vis-a-vis Priceline in the last week and a half. And when you have a bad earnings call, it might present some great opportunities for entry into the stock. So I'm going to ask us to put another nibble out there for PRAA, and if things go the way I expect, I might be back next month with asking us to increase the holdings yet again. That's where we are, Mark. Let me put it back on your screen.
Switch it back to me. Yeah, we're basically talking about another company that's been firing on all cylinders.
And again, what I really like, Mark, is that the managers told me what was going to happen. They told me what they were going to do. And so far now, over about a 1.5 year period, they've done exactly what they said they were going to do, and the results have matched exactly what they predicted. So that's very reassuring in my mind, at least.
Yeah, I think that might be particularly true for debt decisions. Well, both of the companies you guys have presented, they're taking on more debt, but they're doing it strategically and in the spirit of competitive advantage, I would also believe. So.
Yeah, Mark, we have a question from James, and James wants to know, has PRAA ever gotten bad press for its debt collection methods, as has been in the news of late, and leading to some of the new regulations? No, PRAA has most of the time been out in front of the regulations, and many times they've already been doing what the regulations are asking them to do, only they've been doing it for a couple years, 3 years, or even longer. That leads them to be among the top companies with reputation, and it puts them in a small group that banks are right now able to sell their debt to and still meet the scrutiny of some of the agencies that are watching what the banks are doing.
Okay, we clear to press on?
I think we're ready.
Okay. Let's go ahead and spend just a moment talking about this. We don't have a poll for this, so I'll probably choose to do a little bit different approach. But just wanted to talk about, again, over the last year and even over the last 5 years, some of the more favorite presentations that have been put on. I mean, Ken's presentation about Zhongping, and the ticker symbol was HOGS, pulled pork. That was a classic back in 2010, but more so 2011 brought us the Spock and Kirk moment from Hugh, and that was priceless. Again, company-specific stuff from Cy a couple of years ago on Teva and their strategic relationship with Procter & Gamble. I talked about Eddie Elfenbein's Crossing Wall Street a year or so ago, but over the last year we saw some fairly fascinating presentations. As you heard earlier from Matt Spielman back in the April session last year, I mean, he described, I thought, exquisitely, the gentleman that took over the company, walking from one job to the next, literally across the parking lot. I would encourage you to check that work out. Ken and I collaborated on Universal Display. That's the organic light-emitting diode company, ticker symbol OLED, back in that same session. So that could be a good session to check out, going back and looking for potential lessons to be learned. Just a month ago, Hugh basically provided another rundown of his screening technique, where he's constantly looking for, high-quality companies that are on his short list, or his pounce pile, if you want to think of it that way, and talked about the 52-week low and his emphasis on that. He's going to cover that again tonight. And Kim shared with us in the last couple months of the year the work of John Malone, the success of John Malone. And I think finding John Malone is an interesting way to look at successful investors and try to capture things that you can learn, practices that you can implement. Any comments on any of those, gentlemen or ladies?
Our question block is empty right now, Mark. I wish that I could make the poll arrive, but it appears I have to close the session down to create a new poll, and I'm not willing to do that. So,
okay. Well, I'll tell you what I'll probably do then is put a post up that's available to the public also and to Manifest subscribers. And we would just like to, again, in the spirit of not just these presentations, but give us some feedback by casting a vote or issuing a comment about the types of things that you perhaps take the most away with, and we'll make that available. Let's go ahead and press on for now, rather than doing something else. All right, that brings us to my selection for this evening. It's going to be Chicago Bridge and Iron, and what is on display on your screen right now is what we refer to as our heavy hogs. And what the heavy hogs are the most commonly or most frequently selected stocks from our annual stock picking contest at Manifest Investing. And we build a public dashboard, again, called the Heavy Hogs. The link you can see is right here at the top of the page here. So you can get to that at any time. And all I did is I went to that dashboard and clicked on the column, the projected annual return column, so that it's sorted by highest return forecast to lowest return forecast, looking down the list. So again, I'm just using this as a kind of a different screening technique. So I'm getting a little bit of typing background noise. Thanks, Ken. And so this is another screening technique. And again, kind of our theme here over the last month or so has been invest with your friends. And there's no better example than to shop where your friends are shopping, the types of companies that they're looking at, and all of these companies meet that description. So from top to bottom, I mean, some pretty good stuff. Notice that both Air Lease and PRA Group are among those most frequently selected stocks for this year's contest, and they're also near the top of the list qualifying tonight. I'm going to go ahead and go with Chicago Bridge and Iron, even though it's a little bit less conventional of a pick, and sometimes that gets me into trouble. But I do think that the return and the overall outlook and the conditions facing the company probably merit it. Boy, you could have a whole lot of fun shopping amongst any of these companies, including all of these at the bottom of this list. Cognizant and Qualcomm and Priceline have all appeared, at previous roundtables. Just some really good companies there to take a look at. But we'll go with the one at the top, Chicago Bridge and Iron, ticker symbol CBI, and they're just a behemoth in the field that they operate. They're in basically heavy construction, building power plants, oil refineries, all kinds of oil-related equipment. This slide was taken from their Investor Day presentation, which was made back in November of 2014. It's actually a little bit of a clunky slide, but it does sort of make a point. They're into fabrication, building big pressure vessels. I'll come back to that in a minute. They basically are well diversified in terms of, they're in the liquefied natural gas type stuff. You see up here on the left, nuclear power plant. Probably won't see one of those anytime soon in the United States or during our lifetimes, but there probably will be some nuclear power plants built in places like China and other. Again, natural gas, big theme these days, and all forms of piping and that type of stuff for the transmission and distribution of natural gas. These guys are right there leveraged in it. You can see the offshore platforms here. Again, I used to work in this industry. Used to work side by side with these guys. They would supply the structural steel and the what are known as the pressure vessels that can be used in these power plants. For example, I believe they're the only still existing manufacturer or supplier that is capable of actually building the thick-walled pressure vessels that are required for either coal-fired power plants or nuclear power plants. I think they're the only ones that can still make it. So until somebody else comes along, the companies that are in that business actually have to subcontract to them to prepare these very thick-walled pressure vessels. You might think of it as, think about your wastebasket as if the wall of your wastebasket were 10 to 12 inches thick in steel. And then that, there's only a few people that can make that. They are the ones. In fact, their acquisition of the Shaw Group last year basically created that condition. So they're well positioned and diversified across a number of different industries and markets. Here's a quick look at basically the financials for the company, and frankly, this is a slide that almost disqualified them from it, because I don't like when companies put information out like this. They're basically claiming a 33% growth rate, but that's really only true because of this step change here. And going from 2012 to 2013, that's the acquisition of the Shaw Group. It's just a one-time, huge, humongous acquisition of another company, so you really can't compare anything that goes on to the left to anything that's going on the right. This is a brand new company combined by the massive pieces of the pre-existing Chicago Bridge and Iron combined with Shaw. So again, as we look at information, this 33% growth rate is a myth. It's just bad data. So the historical long-term growth rate is in the low teens, and they do have the capability of achieving that going forward. What is true is they took on a company that had a backlog. You heard Matt talking about backlog. These guys also have a huge amount of backlog that they apparently have brought to the CBI. So that's a good thing. And these guys are very good in the engineering and production business. Here's a look at the visual analysis for Chicago Bridge and Iron, and you can see, again, I'm not going to pay much attention when I'm doing a study other than to come to grips with the underlying characteristics of the company here on the left. I'm going to pay more attention to the combination company going forward. And this long-term trend, if you ignore the fact that acquisitions are involved, is about 18%. They can't continue to grow at 18% outside of acquisitions, which are not predictable. So what we basically have is the combined company looks like it's capable of growing in the 11 to 12% range. And again, they are wonderfully leveraged and well positioned in the market where they conduct business. So from top to bottom, you're basically looking at a company that could grow in the 10 to 12% range, $13 billion company. Their margins are, for a company that's this capital intensive and huge, actually pretty steady. And in that 4% range, 4% is certainly achievable. And again, PEs for a pretty well managed industry leader in that mid range, right around 15, all makes sense to me. And very well positioned, kind of exorbitant returns in the upper 20s for a company like this. Notice what can happen to this company in the midst of a deep recession. Notice that the earnings completely disappeared from the screen. They literally fell off and went sub-zero in the depths of the recession. And it's certainly something that can happen to a company like this. Here's a long-term look at the stock price and a condition that many of you will remember we talked about with Apple, the company Apple, being vulnerable to behavior somewhat like this and why you might want to protect yourself. And in this case with Chicago Bridge and Iron, back in the middle of that recession where their earnings went sub-zero, the company literally had a 92.5% price drop like you see right here. Most of us don't survive that type of price drop. That's pretty life-threatening when it comes to an investment. And so it has happened in the past. It could happen again. What I think I see happening with the company, though, is recovery, certainly potential recovery coming out of that situation. Notice how much they gained as they recovered coming out of that. We've been in somewhat of a global recession, certainly with more intensity in some areas of the globe, which impacts this company. Have they bottomed? Who knows? It's tough to tell, but the price charts do suggest that perhaps they have bottomed a little bit. One of the things that I would like to implement, we will talk about in a little bit more detail in future months, is for a company like this. I mean, I had a company last year which basically dropped 98%. I think when you have a company that's non-core, that's vulnerable to that, much like we talked about with Apple in the past, it might make sense to have some type of a sell policy. I mean, I want to protect myself against this type of a drop. And what I'm going to propose that we do and watch and learn from in the case of Chicago Bridge and Iron, that we're going to sell this thing automatically if the relative return drops below negative 20%. Many of you are familiar with the work of Bill O'Neill, and he talks about selling stocks automatically if they drop 8% after the time of selection. And I guess my problem with that is, well, what if the market went down, 5 to 10%? What does that tell you? In this case, we're talking about the relative return, so if the market goes down, we're allowing for that here. We're only going to drop out of this company if the relative return drops down to negative 20%. So it'll be an interesting thing to look at, and we'll explore in greater detail going forward. And that's my nomination for tonight.
Mark,
Chicago Bridge and Iron tickets into CBI.
Mark, could you take 20 seconds and just explain where the numbers will come from to measure the relative return?
We're basically going to be watching the company just like we watch. Let me see if next. I don't have an easy slide to get to from here. We're going to be watching the company just like we watch the entire tracking portfolio. Watching the actual return versus the market return, and watching that continuously. This may be something that we work on with our alert system, by the way. Makes a lot of sense to me that we consider doing that. And so we're going to literally be watching the actual return of the company as time goes forward, and versus the market return.
So you'll compare actual return against MyPAR?
No, against the actual return from the market.
Okay, thank you.
We'll come back and talk about that a little bit later in the Q&A when I can point to the way we track that on every single position that we have for the roundtable companies. All right, let's keep pressing forward. Here's the awards for best accuracy for 2014 and all time. And you can see, again, we've had quite a smattering over the years. This is an award that Hugh McManus has walked away 3 times. Last year, the guest knights, Herb Lemkool and Matt Spielman, wrestled that award away from Hugh. And this year, I'll return it to us with the performance last year. Most of my selections did actually outperform the market. But when you measure that statistic over since the inception or all time, again, you get a pretty good smattering, but again, our all-time leader is Mr. McManus out of Pasadena. So there's 2 more trophies. I think, I haven't switched to my underwear. Picking stocks in my underwear was helpful. Perhaps I would do that. But with that, I think we'll go ahead and switch to Hugh McManus out of Pasadena. And I actually threw up a slide of Ted Williams because, in fact, we could probably pull Cy Lynch into this discussion about baseball. And that's a chart of Ted Williams. He didn't always swing, and he actually charted out where his best results were, and they were right in the middle of the strike zone. So he didn't swing at every strike, and certainly Hugh McManus doesn't do that either.
That is true.
Take it away, Mr. McManus.
Well, this will be short and sweet. If we move on to the next slide, I'll just show you what the sorts of things that I tend to do, and that is I like to find quality companies. Now, not everything on this list is a quality company, but most are, and find out where they're doing with regard to the 52-week high and low. In other words, I want to see how close a company is to its 52-week low. And I just learned to do this many, many years ago because I discovered I was not very good at picking a company based on its price. And since I've started to try to buy companies near their lows, the performance has done quite well. So this is a list of some of the companies that I follow, and the figure on the second to the last column shows how close they are to the 52-week low. So Pain Therapeutics, which I wouldn't suggest you look at right now, but it's within 6 to 7% of its 52-week low. whereas Caterpillar is quite close at 17 and almost 0.5% to its low, and I've bought that a few times recently, but not this time. It's not close enough for me, and in fact, I think the price is a little bit higher than the average price in the portfolio, which is close to $83.50 or thereabouts, even though it has a nice dividend and not a bad yield. And on the next slide, I've added in the projected annual return and the quality. Well, this just really shows the 52-week high-low concept. I show this graph quite a bit. If you picture a ladder and you want to be near the bottom, I like to find it within a few percent, 5 to 10 if possible, but certainly under 25% of its 52-week low. So very near the bottom of its journey up to the top. So moving along to the next slide. Or have we frozen? I've just added the quality that you get from manifest investing. You see down Qualcomm has a super quality there of 100%. And the final column is the projected annual return. And some of these companies, even Caterpillar, have very low par of only 5.8%. Probably want something actually in the 11 to 15% range if possible. And there are a few on that list that have that. Even Bank of America has finally woken up, and I love that company. I think it'll do great things in the future. But for now, the par for Caterpillar isn't looking that good. But really, it's not close enough to its 52-week low for me. I was tempted recently by American Express. It got, I think, fell below its 52-week low for a few days, but actually didn't pounce because it has a very bad dividend yield. So I decided, if we skip on to the next slide, we don't need actually to dwell on this, but there's nothing in that zone that I like. And as I've said before, I want to protect downside. For mid-tier companies, I like companies that are close to a 2 to 3 year low. And for these emerging companies, and Pain Therapeutics would certainly qualify as that, I want something closer to a 5-year low if possible. But the company has to be a quality company. The earnings engine has to be intact. It has to be dominant in its field. And all I'm looking for is something that's cheap in a good way. Let's move on. And so what I'm saying, this, by the way, this is the bottom of the heap. The bottom is in quotation marks. But these are companies near their 52-week high. And you can see very often that the projected annual return is pitifully low when companies get into that area, even though Altria is a company very close to its 52-week high and has a nice dividend yield, as many companies in that particular industry do. But Zimmer and Intuit hit new 52-week highs today, as actually did Walgreen Boots Alliance. It hit a 52-week high as well. In fact, I think a multi-year high, if truth be told. So let's move on then. Right. And what I'm saying in a nutshell is I'm not going to buy anything again this week. The next slide, I think, summarizes that statement by saying nothing. And in the words on the next slide of the immortal character George Costanza, this show is about nothing. I pitched this show to the NBC producers. And I was quite the character in that episode. And so finally, I just sum up by saying basically I'm not buying anything and I want to put my money in a savings account this month. So sorry for dragging it out.
I look for something to be attractive.
Yeah, I want something cheap.
That's all right. I mean, if you had a chance to play with yeah, Hugh, I'm just wondering if you had a chance to play with the components that Kurt has added that give you the possibility of streaming and manifest using some
I've
of the
started to do that. I haven't done a lot, but yeah, I've started to look at that. I like that addition.
If we get a moment in the Q&A, perhaps I'll take a moment and just show you a 15-second demonstration that might help you with some of your shopping. We'll see. All right, let's give the last couple of awards out here. And again, it is kind of a trend. This is the highest relative return for the trailing year. And if you took away the first three companies, then Ken was absolutely on fire last year. I was not on fire last year, but or 2 years ago, I mean. And last year was pretty good to me. You can see these are the actual selections that I made all year long. And Ken, I can actually kind of tackle that question right now. In the case of for Chicago Bridge and Island, we will actually be monitoring on a continuous basis. We'll be monitoring that last column on this page. If that ever hits -20, because what I'm basically doing is, I want to cut my losers short. And in the case of Body Central, I would have loved to have been able to stop those losses at -20. Again, you don't necessarily apply this type of thinking to the average core company, but in this case, as we saw, Chicago Bridge and Iron can be very vulnerable to a big price drop. So this type of protection makes sense to me. So does that help?
I'm getting yes, it does, Mark, and I'm getting a very logical question here. Why not apply it to all?
I think you could. The first thing that comes to mind, and everybody else that wants to jump in, is I do think it could lead to some hyperactivity. I mean, you could jump out of companies a little bit early. For the long-term investor, I don't think it applies to all for a core company. For a core company in a portfolio of a very long-term investor with a long time horizon, never. But again, for a non-core company and in a preservation of capital mode, could make some sense.
Mark, you may recall.
Sounds like a Xerox.
Yeah. All right. I was just going to say, Mark and all, I am generally extremely opposed to stop-loss orders. In fact, I've had presentations that I give calling them guaranteed loss orders, and have shown why. Now, in all of those cases, I usually use a tighter criterion, more along the lines of 10%, which is Can Slim's, O'Neill's threshold, and many people's threshold. And of course, that's also, as you pointed out when you were proposing it for CBI, that's an absolute stop loss, not a relative return stop loss. So I just throw out, I tend not to like them for, as you point out, core holdings. It does seem to make sense to me perhaps for volatile companies that could that would be easy to make a mistake in, and because I would be interested a little bit, for example, Hugh has done very well with Bank of America, and some of Hugh's accolades have been due to Bank of America, yet I wonder, even on a relative return basis, how far down Bank of America got a few times.
We're taking a look at that.
Walgreen was another one that we were taking. Now again, my gut tells me I'm not sure, especially Walgreen and probably even Bank of America in this time we were looking at it, was a 20% relative return loss. But I just say I would step carefully, and I would want to check back, as I say, redo some of my analysis I've done in the past, but do it on a relative return rather than an absolute.
Yeah, I'd be very interested in the analysis, because this is a whole new twist in my mind to base it on relative return rather than absolute return.
Right. Yep.
Yeah, nobody does it this way, and I think we have the tools at our disposal. And again, my intent here is to kick this off as an exploratory topic, and I intend to go back and look at the case studies you guys have mentioned. Walgreen is one of them. I mean, that is not a company where I think this applies. And it'll be interesting to see how that relative return did shake out over time. But we will take.
If I could throw in a couple of cents too. Hey, Mark, it's Nick.
Hi, Nick.
How you doing? If I could throw in a couple of cents too, I would say that I kind of like the concept too, but much like we've always taught, it's not an absolute guarantee that you want to like shoot it down at that point. That could just lead you to more research into why it's doing what it's doing. So if you have a situation like Cy mentioned with Bank of America, where it may have been down that negative 20%, it may still be reasonable to continue to hold it if you understand what's going into it and what the situation is. So it's not, I mean, you're calling it an automatic trigger almost. You may want to just say that's an automatic trigger to go redo your research.
Mm-hmm. Absolutely. And in fact, keep in mind that Hugh's overriding theme through all of that was that Bank of America was not going to disappear from the planet. And that's a different condition.
Exactly. And that's what I mean. That's kind of what I mean is if you know what's going on, then you can make that decision.
Sure. All right, let's press on and finish up here. One last award before the music starts. Highest relative return for the all-time standings. This is the one where Hugh always surges and recaptures the lead whenever he loses it, and he certainly is back. He's beating the market by more than 5 percentage points since the beginning of this contest, and we've had several people sitting in the pole position on this award also. But we might say that we've gone either to the hogs or to the dogs in this case. Those are two of Hugh's finest friends over the years on the lower right there. So congratulations, Mr. McManus. What did he say?
He's the one in the middle.
I'm the one in the middle.
Good stuff.
Excellent. I will just have to keep picking cheap companies.
I think it's a good idea. Well, we should demonstrate your modified screen. And let's go ahead and go with the poll, Ken, and we can close up and switch to the Q&A. If you're ready.
Yeah, let me get this poll up and get it launched.
Now, I'm not going to promise to not to come back in a year from now in my underwear and beat up on the audience, but anything can happen. I actually look at these three companies as all pretty compelling studies.
Okay, did I finally get it up there, Mark? I think I did.
I'll show that the poll is open,
All
Mr.
right.
Cavula. And I didn't think I was on anybody's Christmas list anyhow, so.
We'll give people time to vote here. All you do is take your mouse, folks, and you go to the one that you'd like to have the audience take a position in and click on it. We're up to about 75% of our audience voting.
I'll be thrilled with double digits this year.
I'll give you another 8 seconds here, and we'll see where we're headed. Don't be afraid. Nothing will bite you. Let's get a few more percent out there, pulling the trigger if we can. Okay. There we got 2 more, folks. Just pull the trigger. Just reach up there and press 1 and decide what you'd like to vote for. Okay, let's close this then. And let's share the results with our audience. And oops, let's share it again. And it looks like we're going to take a second position in Air Lease at 42% of the audience, 31% at PRA, and 25% at Chicago Bridge and Iron. Mark, they're not convinced you're a winner yet. You know that?
Well, yeah, but what I was concerned about is the 7%, Ken. That's a dramatic improvement.
Oh, you mean from the last time that you had a crushing defeat?
Yeah. Yeah.
All right.
25%, at least I'm on the board.
Okie doke. So I'm going to hide this now, and Mark, we should be seeing your screen there. We do, okay?
Okay, well, thanks, everybody. Again, I actually think all three of these companies are very compelling, and Matt certainly gave a strong demonstration of how to look inside the revenue growth history and expectations, and that's certainly one of the more important aspects of any study. We do have a whole bunch of stuff coming up. We will be doing another TSP webcast. That's the Thrift Savings Plan for government employees for retirement plans. We've gotten a lot of good press over that over the last year, and we have some programs in development there. But there's the March Roundtable will be March 31st, a little over a month out. And there's just a number of other opportunities. Ken, do you want to push the Stockfest for a second?
Yeah, we'd love to have as many of you as possible that live around Grand Blanc, Michigan, to join us for Stockfest 2015. We sold everything out last year, and we're aiming to sell it out again. So you can drop me a line, and we'll make sure you get an entry form or a registration form. We'd love to see as many of you there as possible. Mark will be there. We'll also be joined by my good friends Ann Cunez and Susie Artsberger. A lot of our directors will be making presentations, and we should just have one great day. Last year, like I said, it was sold out, and it was a terrific day of meeting friends and talking to investors. We look for more of the same this year.
We're going to be building out a number of other programs, so watch for opportunities down under manifest.com events. And we look forward to seeing many of your smiling faces as we roll around the countryside.